Together loans, formerly known as transform credit, represents a unique shift in the lending world by moving away from the rigid numbers of a FICO score and moving toward a trust-based model that relies on personal relationships. For many people sitting with a thin credit file or a history of financial mistakes, traditional banks feel like a closed door, but this tool offers a path forward by focusing on who you know rather than just what your report says. The core of this service is the personal cosigned loan, which allows borrowers to access amounts ranging from $2,000 to $10,000. The structure is straightforward, offering repayment terms of 24, 36, 48, or 60 months, providing enough flexibility to fit different budget needs. While the interest rate is a fixed 35.99% APR, which is certainly on the higher side of the personal loan spectrum, it remains a drastically more affordable alternative to the predatory cycle of payday loans that often carry rates exceeding 400%. One of the most impressive aspects of Together loans is the complete absence of fees. In an industry where subprime lenders often nickel and dime borrowers with origination fees, application fees, and late fees, seeing a $0 fee structure is truly refreshing. It means that when you are approved for a $5,000 loan, you actually receive the full amount to solve your financial pain points rather than seeing a chunk taken out right at the start. This transparency makes budgeting much simpler because the fixed payments stay exactly the same throughout the life of the loan. Furthermore, the funding speed is notable, as money can hit a bank account in as little as 24 hours once the cosigner is approved. This makes it a viable option for those facing urgent financial emergencies where waiting weeks for a traditional bank approval simply is not an option. For someone with a low credit score, perhaps in the 500s, this tool also functions as a powerful credit builder because the company reports payments to the credit bureaus, allowing a borrower to prove their reliability and boost their score over time. However, any educated look at this service must address the significant social and financial risks involved. The most glaring drawback is the reliance on a cosigner who must be 100% legally responsible for the debt. This is not just a casual favor. If a borrower misses a payment, the cosigner's credit score takes a direct hit and they are legally required to pay back the loan. This creates a massive social risk that can permanently damage friendships or family bonds if things go south. Finding someone who has a good credit score, typically 670 or higher, and the disposable income to back such a loan is a high bar to clear. There is also the reality of the 35.99% APR. While it is better than a payday loan, it is still very expensive debt. For example, if someone takes out a $7,000 loan over 48 months, they will end up paying back over $13,000 in total. That means the cost of borrowing is nearly double the original amount. The tool is most effective for credit invisible individuals who have a steady income but no history, or those looking to consolidate high-interest payday debt into one manageable payment. It serves as a lender of last resort that provides a structured path to financial freedom, provided the borrower has a rock-solid plan. If someone already has a credit score high enough to qualify for an individual loan at 15 or 20%, they should absolutely look elsewhere to avoid the high cost and the involvement of a loved one. The limited $10,000 cap and the fact that it is not available in all 50 states are also logistical hurdles to keep in mind. In summary, Together Loans offers a valuable lifeline for those who have a trustworthy friend or family member willing to back them up, especially since there are no hidden fees and the application process is fast. It provides a genuine opportunity to rebuild a damaged credit profile through consistent reporting. However, the risks are substantial and should not be ignored. The 35.99% APR makes this a very high-cost way to borrow money, and the legal burden placed on the cosigner means that a single missed payment can ruin a relationship and a credit score simultaneously. You should only move forward if you are certain your income is stable enough to meet every single monthly obligation without fail.